morning. I'm Pete Seyler, and this is Markets in a Minute for the week of July 13th. Just when it looked like we had the makings of the kind of sector rotation that often defines late-stage bull markets, this week's geopolitical developments threw a wrench into that story. The rotation that began after the U.S. Iran peace deal is showing some cracks following Iran's strike on cargo ships in the Strait of Hormuz. The U.S. response, and President Trump saying he believes the ceasefire may be over. Investors continue to favor defensive sectors like healthcare, but others, such as consumer staples, could be vulnerable if higher transportation costs push inflation back up. The rotation has been fueled by optimism around margin expansion, not in tech, but across the rest of the market. If energy prices and inflation continue to rise, that thesis comes into question. On the economic front, it was a quieter week with little market-moving data. The ISM Services report showed the services sector remains strong. Two items stood out. First, prices paid cooled from the prior month, but still came in at a very hot 67. Second, the employment index rebounded from above 50 after posting 47 last month, beating expectations for another soft reading. Remember, 50 is the line between expansion and contraction. The takeaway? Services remained resilient, hiring improved, but input costs are still elevated. We'll be watching next month's report to see if lower energy prices and the ceasefire begin showing up in the data. The other interesting release was consumer credit, which contracted by about $200 million versus expectations for a $17 billion increase. There are plenty of theories: consumers paying down debt, tighter lending standards, or weaker demand for big-ticket purchases like cars. For now, we think debt paydowns are the least likely explanation, especially since many have argued consumers have been relying more heavily on credit cards to keep up with higher prices. Drilling deeper, it seems that revolving declined by 4.7%, while non-revolving increased by 1.6% annualized. One possible explanation is that high-rate credit card debt is simply being refinanced and termed out, shifting revolving to non-revolving debt. PCE also supports this as numbers remain stable, suggesting more so a shift in credit behavior rather than broader slowdown in spending. We'll get a better picture as more consumer spending data comes in. Finally, the Fed minutes didn't contain many surprises, with the biggest takeaway being that several FOMC members favored raising rates at the last meeting. That's it for this week. Next week, we'll cover CPI and PPI, which are due later this week. Buckle up. Have a great week, and thanks for watching Markets in a Minute.